Thanks for joining David and I for the market update for the month of February. Before we get started, I just want to bring to everyone's attention, most of you would have got one of these fee schedules in the mail. It was an accident by WorldSource. Someone hit a button and sent one out to everyone, whether or not you actually have it. So 99.9% of you have none of these fees or these costs. Unfortunately, it went out. If you have any questions with it, let us know. I think first off, why don't we take a look and see how the markets performed in the month of February. David, I mean, obviously with what's going on, it's absolutely horrible for the poor people of Ukraine. So clearly we're having a lot of volatility right now. Again, I'm not concerned with the volatility. We've seen this before. This is what we call event volatility. The volatility is created by an event, not actually the profitability of the underlying companies. That's what you and I spend so much time looking at to ensure that our clients are invested in the right things. So again, lots of volatility in February. I'm not going to be surprised for that to continue through in March as well, and eventually start settling down a little bit.
Yeah, it was definitely, been a bit of a tough February, building on January, with Russia's forces building up outside of Ukraine for the past several weeks, then obviously them invading just last week, actually going across the border. It was interesting, though, to note that the markets were kind of gradually sliding for most of the month. And then on the day of the actual invasion, North American markets were actually quite positive on that day and even the second day of the war. So it just goes to show you how difficult it is to say X is going to happen and Y is going to be the result in the short term. Nobody really knows. So Harry and I, again, like Harry said, we don't even try and bother predicting on a day-to-day basis what's going to happen. But it was interesting that North American markets, at least initially, responded okay to it. Obviously, the Russian markets have been clobbered. The Russian stock market was down over 40%. Their currency, the ruble, has crashed over 40% as well. So everyone around the world selling off Russian assets, as you would expect, because of their mind-boggling decision to invade the Ukraine. And all the sanctions that now the West is imposing on Russia is going to make it pretty tough on their economy in the next little while. But with the market, Harry, do you think the market's going to continue to slide here?
Yeah, David, that's a good question. Short term, the answer is probably yes, but long term, we know that's not going to happen. As I mentioned before, we're in what we call an event volatile time. So the event is causing the volatility and the short term downturn. It's not the market itself. Corporations, we're looking at them, are still actually quite profitable. So, we've been looking at numbers coming across the board that have been very, very positive. Again, we've seen this before. When an event of this magnitude happens, people get emotionally involved and they no longer look short term at the actual data. They just emotionally start making decisions. But we know as time goes on, eventually they'll get back to looking at the fundamentals, the profitability of the underlying assets, and that's what's really going to dictate how well they do. And again, David and I always know that these type of things happen, and that's why we structure everyone in those three wonderful balls that we always talk about, where any of your short-term needs are in a fixed income anyways. So we know that the investment will be volatile at time periods, and we're just going through one of those right now, David.
Yeah, and the National Bank investment arm actually put out a pretty interesting report. I think they released it just before Russia actually went into Ukraine, but they were looking at going back to in data back to 1939 and the S&P 500 around military conflicts historically, and their data showed that historically it's the month before the actual start of a military conflict that tends to have the worst market performance, with historical performance showing positive returns only 27% of the time, with an average return of minus 2.1% for the month leading into a conflict. And interestingly, the following 3 months immediately after a military conflict begins are positive 73% of the time, with an average increase of 3.7%. So naturally, these historical trends don't guarantee what's going to happen next with the Russia-Ukraine situation, but typically, if history is a pretty good indicator, and so far in February, the markets were down a little bit more than that historical norm we just quoted. So perhaps if things work out okay in the next little while, we may see an even more robust rebound in the next few months here. Harry, what do you think? Do you have any advice for investors at this period of time?
Yeah, I mean, the advice I give you is don't panic. Unfortunately, even though this is horrible, what we're seeing is this type of volatility is normal in the market. And David and I always know that there's going to be this volatility at different times. So we build your portfolio to be able to stay protected for your use. This is also one of the reasons why David and I always do the comprehensive financial plans for you, because we've determined what income you need now and what income you're going to need later on. And so we're able to build your asset allocation in those three balls. And if you remember, anything you're spending in the next 3 years in the short-term fixed income, anything in the next 4 years after that is in the midterm fixed income, and the rest of it can go into conservative dividend-paying equities or ownership of stock. And so we've built your portfolios to be able to get through these time periods. And I stress these time periods are short in nature. You're not looking at a negative market for 20 years. Generally these type of event volatility sort of run over a 3-4 month time period. Again, you can't be exact with these things, but in general they are, shorter term. And then eventually people go back to the economics and they look at the fundamentals of the different assets that are inside their holdings.
Yeah. I think it's important to remember that obviously don't panic is great advice, but it's also important to recognize too that as humans, from an emotional and perspective and how we're wired, whenever there's uncertainty or danger, or we perceive that there's danger, it is natural for us to want to take shelter, to want to do something to protect ourselves. And as an investor, your natural reaction would be to move to something. I've already had many clients ask me, can we move the portfolio to something safer? Well, really, the only thing that is quote unquote safer is you can either go to cash if you really want to protect yourself, which is fraught with its own risks, because again, as that research showed, that after the 3 months after a military conflict, typically the market's going to bounce back. Well, if you're in cash, you're going to miss the bounce back. But also, we already have a measure of safety built into everyone's portfolios, as Harry talked about, the fixed income, and then investing in high quality dividend paying companies by their nature is a relatively safe investment, because in an inflationary era like we find ourselves in, if you're investing in companies that are paying an escalating dividend over time, that's going to help retain your purchasing power. And at the end of the day, as long as companies are selling products, selling services, and continuing to grow their businesses, whether there's a military conflict in one corner of the world or not, that's really what matters 2, 5, 10 years from now.
Yeah, great advice, David. As always, if you have any questions, anything that you want to chat with David or myself about, please don't hesitate to give us a call. But I really stress, I don't like this short-term volatility. I absolutely am horrified with what's going on for the poor Ukrainian people. But I'm not worried about the market. This is strictly a short-term issue that we're going to have to go through as far as the market's concerned. Take care.
As always, if you guys have any questions, give us a call.
Bye.